Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. 1922. Post-war Germany, under the rule of the newly formed Weimar Republic, found itself under significant duress, struggling with the demands of onerous war reparations demanded from them by the victors of World War I. This, combined with the domestic efforts to rebuild a post-war nation, combined with hits to productive capacity, like the French occupation of the nation's most powerful industrial centers, gave the government little option but to print more money to get their economy working in any capacity. This reckless printing, combined with equally reckless borrowing and reduction in productive capacity of the nation, saw the value of the German paper mark tank to the point where banknotes were better used as fuel to heat households, rather than units of exchange. In 1945, Hungary, a nation devastated by the fallout of Second World War, to businesses to rebuild from ground up, and reduction in productive capacity of the nation, saw the value of the Hungarian pengo tank to a point where prices were doubling in the nation every 15 hours. 2009, North Korea. Farming output was hit by sanctions and a poor year for weather, money printing, hyperinflation. Hyperinflation in all these examples, which are just a selection from the last century. There are a few very noticeable common trends. Destabilizing event, be it a war or a natural disaster, or a piece of policy that leads to a sharp decline in productive capacity, which is corrected with stimulus, measures funded by the printing of money. Unfortunately, almost all of these examples result in some form of failed state. Economic downturns are unfortunate realities, but they are to be expected. Market crashes might sting a few investors and push average people's retirements back a few years, but for those with a time horizon and fortitude of spirit to hold onto a broad portfolio of assets, everything normally ends up just fine. But hyperinflation is different. Almost no economies recover from this diagnosis without some type of massive regime change or total abandonment of sovereign currency, neither of which are particularly appealing options. Hyperinflation is game over. 2020, the United States of America, in fallout of the coronavirus, hit the nation particularly hard. While the human cost of this ordeal has obviously been most devastating, the pandemic has had an undeniable impact on the economy. Millions are still out of work through no fault of their own. Many small, medium, and even large corporations have been forced to close permanently. Once stable industries like tourism, hospitality, in-person retail, and entertainment have been all but eliminated, and despite hope on the horizon for things getting back to normal, these sorts of industries are not going to be back at full capacity for a very long time. To combat this massive drop in economic output, the US has printed more than a third of active money supply in the economy today. Within the last 12 months, this money printing has combined with an increase in private sector borrowing and a drop in productive capacity due to the devastation by the global pandemic. If this set of circumstances sounds familiar, from the same consequences as all these other examples, and what is the best way for people to protect themselves against this kind of worst-case scenario? Inflation is a weird concept that can be very frustrating for people to understand. We base economic value on how much a currency is worth, so when it comes to assessing the value of the currency itself, things tend to get a little bit weird. You can almost think of the true value of currency as its exchange rate between other things of value. We do this all the time with different currencies, no problem at all. Of course, normally we express these exchange rates the other way around, but you can start to see that the market value is almost always expressed as an equation of dollars to goods. Now, moving on from this example, imagine the relationship between the US dollar and the S&P 500 index. Again, we express this as an equation, with one of the units of the index being worth approximately 400 American dollars. Sure, there are a few companies that have benefited from working from home or delivering products to combat the pandemic, but most companies are struggling. Global supply chains have been slowed, making production more difficult. People are moving about less, therefore burning less fuel, and this is all to say nothing if companies directly involved in tourism or hospitality, which are now basically on government life support. Fair to say that this collection of 500 companies is less good than it was 16 months ago. It's producing less, making less profits, and is far more reliant on government subsidies that may or may not continue into the unforeseeable future. It would therefore stand to reason that, all other things being equal, this index would be exchangeable for fewer American dollars today than it was back at the beginning of 2020. But of course, that's not the case. In fact, it's exchangeable for $30 more than it was at the beginning of 2020. Now, of course, we normally see an appreciating stock market as a good thing. But again, That's because we measure value from the perspective of dollars. If the stock market appreciates in value, we naturally assume it's because the companies in that market is doing better for them investors. Of course, normally, inflation is measured using one of these relationships between dollars and asset, but it's not any of the examples that we have seen thus far. Instead, it's a collection of goods and services called the Consumer Price Index. You can find a list of what's included in this index in your own country, and it does vary from country to country, broadly representing the spending habits of consumers in that nation. Now, normally the value of these items is highly correlated in the short to medium term with these other assets. For example, if the cost of real estate rises, rent will be higher as a result. It means businesses are going to have to increase prices to stay competitive, and those extra charges will be increasing prices in the register index of consumer prices. But here's the thing, it hasn't. Inflation has remained comfortably below 3 for this entire money printing ordeal. This becomes even more bizarre when you consider one of the factors that contributes to the price tag of things. The same is true for lumber crops like corn and soybeans that make up a good portion of the food that we eat, are up more than 70%, but the Consumer Price Index, an index of things that are made from steel, wood, corn, and soybeans, has barely moved. So what is going on here? Is there some creative or potentially fraudulent accounting going on, or is America too good for inflation? Now, so far, the two big forces to consider is that the US has made a lot of money while not making as much stuff. This means that there is naturally more money bidding for less stuff, which drives prices up. Simple supply and demand. So far, these price hikes have been exclusively in asset markets like stocks, cryptocurrencies, real estate, and raw materials. But despite the direct relationship in these markets and markets for consumer goods and services, the Consumer Price Index that actually acts as the gauge for what we report. Now, there still might be one saving grace for the American economy, and that is its currency status as the world reserve. Now, this term is thrown around a lot, and people will often use it in this debate to argue away the possibility that the US could end up like Venezuela, regardless of how much they let the money printer run, but often people don't fully understand what it means back 70 years ago. Today, it means something different. US dollar is no longer backed by gold, and most global currencies are not pegged to the US dollar, and are instead free-floating on the foreign exchange market. Today, it simply means that the US dollar is the most widely held foreign currency by other nations. China alone holds close to 3 trillion US dollars, and total global reserves top 7 trillion. What this effectively means is that the value of the US dollar is not only dependent on what can be purchased within its own domestic market, but also what it can purchase around the world. Assume you wish to purchase a bulk order of cell phones from China and bring them to the United States. Let's pretend your home nation is Canada. You wouldn't be able to afford it. In Canadian dollars, those phones, the Chinese manufacturer of these phones, are likely to query what you're saying. However, if you offered American dollars, they would likely be far more accommodating because American dollars are far more widely recognized. In fact, this sort of deal happens all the time because American dollars are easier to deal with than Chinese RMB. This is part of the way that China has been able to accumulate so much American money. So, the value of American money depends on the productive capacity of the planet, more so than the productive capacity of the states. This does genuinely give American dollars some resistance to depreciation, but it's not limitless, and it also doesn't protect the United States from a situation where the entire global economy is impacted, like, let's say, a global pandemic. Now, of course, this isn't necessarily a foregone conclusion, but the writing is on the wall. So the next logical question you might be asking is, how do you prepare for this now? The traditional answer to this would be to hold real assets like precious metals, productive real estate, or even stocks in companies that wouldn't be too heavily impacted by domestic currency fluctuations. New age solutions might include cryptocurrencies, and it's difficult to say that this was bad advice in the past few months. But there is a more direct solution: shorting currency. Now, you might ask, how do you do that? Typically, if you want to short something like a stock, you need to borrow from that stock from your broker, then sell it instantly in the hope that the price falls so that you can buy the same stock at a lower price to give back to the broker you originally borrowed it from. But how would you do this with money? Well, it's simple. You borrow money, you then exchange the money for some kind of underlying asset, like, let's say, real estate or a stock portfolio, hoping that money becomes worthless so you can give it back more easily later. Imagine this. You were shopping for a new home in Germany in 1920. A lovely flat in Berlin would likely run you about 10,000 paper marks. Pretty expensive back then, but whatever the nation was, on the up and up, and under the control of the new Weimar Republic. So you put down a deposit of 2,000 paper marks and borrow remaining 8,000 with a fixed rate mortgage. Fast forward 2 years and hyperinflation has gripped the nation. This is obviously causing all kinds of issues for day-to-day life, but it presents you with an interesting opportunity. But a healthy level of debt used to purchase stable assets can be a good hedge against inflation. The thing is though, wealthy people know this in an environment where sophisticated investors are anticipating inflation. They will look to take on more debt to invest, especially when the debt can be taken out at record low interest rates. Lots and lots of rich people borrowing lots and lots of money to invest naturally increases the demand for and therefore price of those investments, while also putting more cash into circulation. More money floating around in an environment where everything is being brought up as a hedge against inflation, ultimately causes inflation. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.